Good evening and welcome to our webinar. Tonight's webinar put on by Libro Credit Union. Let's make money better. Tonight's webinar, skip forward a slide please, is focused on year-end tax tips with a particular focus on charitable giving. Our featured speaker tonight is Doug Carroll from Aviso Wealth, and I'll be your moderator this evening. My name is Paul McQueen. I'm the VP of Wealth at Libro Credit Union. I want to welcome you all to this call on behalf of all of my Libro colleagues. Our 36 locations across southwestern Ontario are closing in on 110,000 owners. We're excited to have this webinar this evening. We're excited to have our speaker. And it is very strange that this is our final webinar in the 2021 series. Libro supports a number of pillars. We thought this was worthwhile noting, and given the topic tonight of charitable giving, we try to be both a supplier of funds, but also supplier of assistance, information, and expertise to help and support different areas in our communities, including employment, financial resilience, local food accessibility, and housing. So well-timed conversation for this evening. In terms of our webinar, just a few success tips. Given the nature of the program this evening, if you do have questions or comments, if you can please use the chat feature. You can see and hear us, but we cannot see or hear you. So the chat feature is really the only way to get those questions and comments through. If there are any questions that happen to be of a overly personal nature, we'll do our best to answer them in a general sense, but we may need to refer you to one of our coaches for more specific information. Tonight's topic on charitable giving is the focus for the year-end tax tips. Our speaker, Doug Carroll, is also going to be presenting a webinar next week, 21 timely tactics to trim your taxes. That's a nice, easy alliteration for me to say. Those will be available live on December 14th at 12 Eastern with a second edition, December 15th at 3 p.m. Eastern. Our speaker tonight is Mr. Doug Carroll. Doug is a tax and estate specialist with Aviso Wealth, a national integrated financial services company which serves the wealth management needs of almost every credit union across the country, including Libro, as our dealer partner for investments and insurance. Doug has held roles in the life insurance and investment industry, combined with hands-on experience of running an estate planning law practice. So he's certainly qualified to offer practical insights in personal wealth matters. Doug has organized and spoken at hundreds of events. I may have to up that to thousands after the number of webinars he's done for us since the 1980s on financial planning matters. He contributes to and has been quoted in the financial industry media, including the Globe and Mail, National Post, Toronto Star, BNN, CTV, Global TV, etc., etc. Doug holds a degree in business administration, a Juris Doctor, and a Master of Laws, which, personal note, I think that's a really cool degree, Master of Laws, with a specialization in taxation. He's also a trust and estate practitioner and a certified financial planner professional who previously sat on the board of directors at the Financial Planning Standards Council, the overseeing body for CFP professionals in Canada, now referred to as FP Canada. Professional qualifications aside, Doug gets the greatest satisfaction when people say he actually speaks English when he speaks law. So, without further ado, I will turn over the hosting to Mr. Doug Carroll.
Okay, great, Paul. You let me know. You can see my screen up there, the slide, and I will. I'll take it from there.
Looks
talk
good,
about
sir.
This topic. Very good, thanks. This is a topic which it's in one sense it's very simple, and the other way it can be complex, and it's one of those things to talk about charitable giving as I'm speaking about it in a tax sense. Some people may feel, maybe not offended, but may feel that it's not the same conversation. If you're going to be charitable, then be charitable. Don't try to be profitable at the same time. But I think that there's certainly a way to be charitable, to take care of the organizations that you want to take care of and the people who are assisted by those organizations. And by doing so in a tax efficient way, you can actually help yourself and help them even more. So it's definitely something to be be aware of the way that the taxes work for charitable giving in order that you can do it as effectively as possible. So I'll take you through a number of topics here, 10 topics over the course of perhaps about a half an hour to go through the content here. And I will start to touch again on the notion of being strategic about how you make use of the donations that you make, and then I'll get into the structure of how donations are dealt with in our tax system, and then ways that you can strategically make your donations, whether that's on a year-to-year basis or it is perhaps looking at something that you do through your estate and how the tax rules can support you there, or if not necessarily through your estate, then doing it in a way that you can take advantage again of tax rules that are set up so that you can make significant donations that that will benefit those organizations and effectively pull the tax dollars that otherwise would apply and be paid out to where the government decides where to allocate those tax dollars, and instead allocate them towards the kind of services that you want to support and the charities you want to support. So I'll take you through these 10 topics here. That's enough to just give you the outline so you can see the 10 topics as I'm going through them. And as I said, you certainly should not be leading with the idea of how do I save money by donating to charity. It's one of those things that is played on quite a bit in some of the tax schemes, the schemes and scams that are promoted, suggesting to people that if they do these donation tax shelters, that they, and I'll say they rather than you, can actually end up being better off personally by a significant amount by making donations in a very complicated way. I think that in order to position this properly, it is necessary to think in terms of who do I want to take care of? How do I want to take care of them or the organizations? And then turn to the way that you can make that more tax efficient. And again, two ways that you might be able to do that. If you have a clear understanding of how the tax rules work with donations, then the benefit of that tax relief that the government gives could allow you to donate more or to donate the same but have the charity end up with more, or the combination of those two. So it does always start with who do you want to take care of? Do you have that charitable intent? And then what can we understand about the tax system to then make it more effective for us in making the donations? So this is the base way that our tax system gives recognition to charitable donations. The way that it's sometimes portrayed in just general language, people will talk about getting a deduction from donating to charity, but you don't actually get a deduction when you donate to charity. If you sat in on some of the previous sessions that we've done, I talk about in various places the difference between deductions and tax credits. Deductions are generally more valuable than tax credits because a deduction, we've got a progressive tax system where we pay higher rates of tax and the higher levels of income. So if you can take a deduction, then you're getting a tax break at the high level up here at your marginal tax bracket. Whereas tax credits generally are set up so that if you owe taxes, then the credit gives you a reduction of those taxes at the lowest tax bracket level. But with a charitable donation, it operates a little bit differently. There's a two-tier way that charitable donations operate, where in a year, the first $200 of donations that you make, you get a tax credit at the lowest bracket rate. So federally, that's 15%. Provincially, here in Ontario, that's 5%. So you get about a 20% tax credit in round terms. Not exactly 5 for Ontario, it's just over. But you get a low tax credit rate on the first $200. But then on the dollars above 200, you get a tax credit up to approximately top tax bracket rate. So it's nearing, or in some cases, if you're high income level, over 50% tax credit that you get for that. And that may apply if you yourself are at a, let's say a 30% or so tax bracket rate, around $50,000 or $60,000 of income. And when you make a donation, the tax credit you get above the $200 gives you that really high level. So you're donating money where the tax credit is actually larger than your own exposure to taxes. So it's a really good deal to get that kind of a tax credit working for you. Between you as spouses, two people as spouses, you are able to combine your donations. So for most purposes, we each one of us is a separate taxpayer. It's distinct from one another, even between spouses, although a lot of the tax features of being spouses do allow for opportunities as well as creating restrictions. With donations to charity, regardless which of you makes a donation to charity, the Canada Revenue Agency allows for spouses to combine their donations in a year so that you can more quickly break through that $200 level and get to that higher credit rate. So it's a good idea with spouses to actually combine those so that you can do that. And then, as I said, if you're at a mid-income level, then you very well may be making donations and getting a tax credit that's even higher than the exposure that you have to taxes. So it's a good deal to be able to make donations to causes that you care for and to be able to get a significant tax break in doing so. The limit to the amount that you can make use of for your charitable donations is that you can offset in a year up to 75% of your net income when you make a donation to charity. And there is a 5-year carry forward of that. So if you make donations and you don't have, or you break through the 75% of net income level, then you can carry forward the remainder of the donation credits and use them in future years. And when I say 5 years, I mean the current year plus 4 years that you're able to carry that forward. The other possibility is you could collect up donation receipts and not claim them in a given year, claim them up to 5 years out there in the future. And in that way, it operates pretty much the same as if you would claim them, if you'd log them but not claim them against your current year's taxes, or if you accumulate those receipts and then claim them in a later year, you can claim as much as 5 years back in time to be able to then combine and get through that $200 amount. The other possibility, last point here on the page, the other possibility would be, and this has to be taken in consideration of what the organizations need and what your commitment may be, whether it's an actual commitment that you've given to them or your intentions for the organization. Instead of making periodic contributions to the charity, maybe what you do is you make a very large contribution in a single year rather than small amounts each year. So again, you push up into that above $200 level to get the higher tax credit working for you then. The donation itself can be in a number of forms. We commonly think of giving cash for our donations, but there are other things that we can make donations with. We can give valuable items like artwork or some kind of collectible. Those things do present a little bit of a challenge if the charity is receiving that and doesn't know what to put on it as a value. That would generally be something that you would do if you have particularly large valuables that you want to make a donation, and you'd be able to then use that to make the donation rather than using the cash that you have. You can also donate securities, public securities, and I'll come back to that in just a minute. the way that you can make donations of marketable securities, whether that's stocks or it's mutual funds, perhaps. You can do that in a way that, again, gives you a tax break and gives as much to the charity. You cannot, at this point, donate private shares, though. So if you have your own business and you're contemplating donating the value of your business effectively through the shares that you have to a charity in your local community, as it stands right now, you are welcome to do that, but you don't get the preferred tax treatment that applies on the donation of public securities, marketable securities. So just hang on to that thought, and I'll explain to you how that works when you donate marketable securities. You may donate real estate. It's certainly a possibility to transfer over real estate. You're obviously talking about very substantial gift. It's probably something where if you're wealthy enough that you can afford to do that, not put yourself in the poorhouse in the course of doing that, then you may want to make a donation of real estate, particularly if it is real estate that is relevant to the particular organization. Perhaps it's in a location that they can make use of. Maybe it's of a type that they could make use of, like wetlands of some sort. So you can make donations of that type of an asset, real estate. You can make beneficiary designations off of your registered plans, RRSPs or RRIFs, where you name a charity as beneficiary. The benefit of doing that is that if you're familiar what happens at death from a tax perspective, the amounts that you have in your RRSP or your RRIF, they're brought into income in your terminal year. And so it pushes you up into higher tax brackets. But if you name a charity as the beneficiary on that plan, if that's who you want to take care of anyway, then yes, that is brought into income in that year, but then you're immediately donating it over to the charity, and it effectively negates the tax. It takes a couple of steps involved in the filing of your final tax returns, but it effectively negates the tax that otherwise would apply by the income inclusion, because you then make the donation over to the charity via the beneficiary designation off of those plans. In a similar way, in terms of the structure of making the donations, you can make donations using insurance beneficiary designations, and I'll have a little bit more to say about insurance in just a few minutes. And you can also make donations of what are called remainder interests. Again, I'll explain that on its own. That's going to sound really confusing, so I'll explain that shortly. And you can also make donations of cultural gifts and ecological gifts. Cultural gifts would be things that have a particular significance to the of cultural significance, obviously, to the country, to the organization that you're donating to, and so those types of donations are given extra benefits to the tax treatment of those. The 75%, the maximum net income that be offset in the usual way that we apply the tax credit, it's bumped up to 100% when you make donations of cultural and ecological land gifts to charities. Okay, so I said that I was going to talk about donating securities and the special rules that apply to securities. So let's say that you're in a situation where you have some cash and you also have a security, and I'll say it's a mutual fund, which has increased in value. So my numbers that I'll use, so I can keep it round for myself, is let's say that you've got $1,000 in cash that you are thinking of donating, and you also have a mutual fund, which you've held for a fairly long period of time, which is also worth $1,000. And it was something that you purchased back in time for $400. So you have a $600 capital gain on that. I don't know if that's best numbers to use. I'm going to create challenges for myself here. But so you bought it for $400, it's worth $1,000. If you were to donate the cash, then what you'd be left holding on to is that security waiting with its waiting capital gain. You have a $600 capital gain. So you give the $1,000 cash, you hold on to your security that is worth $1,000 on the face of it, but it's going to have tax associated with it. On the other hand, let's say that you wanted to donate, you want to hold on to the cash, but you want to donate the value of the mutual fund. Then what you could do is you could sell the mutual fund. You would have a $600 capital gain. Half of that would be taxable, so 300 of that would be taxable at whatever your tax rate is. So something less than $1,000 would be netted from that if you sell the mutual fund, if you redeem it, and then you give the charity the cash for that. Well, let's look at it another way that the rules allow you to do. You can take the mutual fund and you donate it to the charity in kind. So rather than converting it into cash and then making the cash donation, you take the security and you donate it in its current form as a mutual fund to the charity. And when you do that, the tax rules allow the capital gain to be negated. So the $600 capital gain that you had on there, which led to a reduction in the cash available, it does not apply. You make the donation of the mutual fund in kind, the charity gets a $1,000 mutual fund. It's not a taxable entity, or it doesn't pay taxes, the charity. You then get a tax credit for a $1,000 donation instead of something less than $1,000, and the charity has a full $1,000 when it sells that off. That's what it's going to do once it receives it. It will receive it in its brokerage account, and then it will sell it and will net the funds there, so that the charity has $1,000 effectively to work with. You have $1,000 of tax credit, and you had that other $1,000 cash that you had in your hand that you were considering, should I donate this or should I donate to charity? So donating the securities in kind is a much more efficient way to make the donation, both for the charity to have a larger amount available to it and for you to have a larger credit associated with it. So between you and the charity, you're no worse off. You're both better off. The only worse off party in the whole arrangement is the Canada Revenue Agency. I'm not one of those people that points fingers and say, oh, the tax man is so evil and terrible. But if the tax rules allow you to do this in order to support the charitable causes that we care about, then why not take advantage of that? The only loser in this, if you can call it a loser, is the fact that the Canada Revenue Agency, or the government in behind the Canada Revenue Agency, has created these rules to support people who want to make donations in a tax efficient way. Another way that you can do your donations, if you would like to be able to have a continuing involvement in the management of the money which you donate to the charities, you can do what's called a donor advised fund. And some people talk about this as being your own private foundation. And I would put quotes around that, because an actual charitable foundation is a very substantial sized operation and takes a lot of effort and a lot of cost to establish and to run. But using these donor advised funds, what you do is you donate an amount to a foundation, so to a charitable foundation. The charitable foundation then gives you a tax receipt for the amount that you donate, and then allows you to continue to make decisions about how that money, which they have legal control over, how that money is going to be managed. So you can have your own financial advisor be the advisor on that money that the foundation is controlling. And you can then have it dole out from the foundation over to the charities that it is connected to, so that you will be able to make a donation at one time, which will continue to be invested, that you can keep an eye on. And then from time to time, you will give instruction to the foundation to say, I would like now $1,000 to go to this charity and $5,000 to go to that charity, etc., over the course of time. Each of them operates a little bit differently, but that's the general structure of it. It allows you to get your tax receipt for the large amount you donate, continue to guide the investment of that money, which might be something, particularly if you are interested in responsible investing, being able to guide how it is invested so that it keeps in alignment with the charities, perhaps, that you want to take care of, and that the money actually ends up with those charities. So it's a neat way to try to combine all of those charitable intentions. As I mentioned, you can use RSPs to make your donations. You can name the beneficiary on the RSP, the income on the RRSP or the RIF. It is brought into income in your year of death, so you can name the charity as a beneficiary as to the entire amount of the RSP or RIF, or a portion of it. Now, in some cases, you may want to reserve for yourself some discretion about how that might operate. So instead, what you could do is you could use your will to direct what happens with the registered plan going over over to the charity. So you can create terms in your will that puts boundaries around it and make sure that you're working with a lawyer who is familiar with doing this kind of thing. Or you could have the amount of the RSP or the RIF fall into your estate, and then the charity could be a beneficiary of your estate. So you could make sure that you didn't end up in a position where, unfortunately, you gave a large amount to charity. Not you didn't want to take care of the charity, but a larger amount to the charity than you intended, proportionate to those family and friends around you who you wanted to take care of. So you can be a little bit more intricate in the way that you make that donation in that case. And once again, if you have the income inclusion of the RSP or the RIF money in the year of death, you have a very high tax rate. You're pushed up into higher tax brackets. So it is quite possible that you can make a donation in this way so that the credit amount that you get on the donation to the charity could be effectively offsetting a substantial and possibly all of the tax that applies in your year of death. And again, with some good guidance drafting of the will, it could allow for the charity to get a substantial amount and to negate the taxes or a significant amount of the taxes, and to support those family members who you want to take care of as well. So it's a coordinated way to go about doing that. In the estate, you can make again transfer or donation through your estate. And when you're making a donation to a charity, it's important to understand the distinctions among the ways that a beneficiary receives their entitlement out of an estate. We have bequests that can be made, and bequest is the transfer of a certain item in its form. We have legacies, which are specific dollar amounts, and then we have the residue, which is the leftover after bequests and legacies have been paid. So you could choose to make the charity a beneficiary of one of these three types. It could be that you have a particular item that you want to give to the charity, and in its current form, maybe one of those cultural gifts, for example. You could want to have a specific dollar amount defined for you. Clearly, that's the amount that's going to go to the charity. You don't want that to become a larger proportion than what you're taking care of your family members. So you've said to yourself, and you would say in your will, it's going to be X amount of dollars. Or you could have the charity, again, as one of the residual beneficiaries that participates in what is left over after those things are paid. It depends on you and whatever the extended family you have around you, how you want to go about structuring that. When you make a donation via your will, the way that the donation operates, again, distinctive from what happens during the course of your life. During the course of your life, again, you have a 75% limit on a yearly basis of offsetting net income. But when you make donations in your estate through your will, then the donation can be used to offset up to 100% of the income in your year of death. So that's January 1st to the day that you die. And it can be carried back to offset up to 100% of the taxes that applied the year before death. So you've got a really large amount of tax credit that could be available to you to reduce down the taxes that otherwise would be applying, both in your year of death as well as the preceding year, which would have been a full income year in many cases for people. And so it's a way that can recover taxes, again, along with making your donations in the way that you want to make them. As I mentioned, insurance can be used. It's one of the ways that you can make a donation and have very high certainty that the donation is going to be carried out, and that you're not going to end up with, through an estate, a challenge to the donation. So if you make a donation through your estate, through your will, potentially, depending on who the beneficiaries are of your estate, or the would-be beneficiaries, if there's a challenge, potentially there could be a contest, a challenge to the will, and your donation to the charity may not actually be carried out or might be delayed. But if you do it by way of an insurance contract and you name the charity as the beneficiary, then you are able to have that transfer of that amount go to the charity with that high level of certainty. The other thing is that if you have your money come into your estate and then go out to the charity, particularly if it comes from an insurance contract, then you're exposing that money coming from the insurance contract to estate creditors, if you have that as a concern currently, or if you die in a circumstance where there might be some liability involved, then there might be creditors. Costs of administering the estate might limit the amount or reduce the amount that goes out to the charity. Probate would apply on the amount that's received into the estate, and then eventually the payout. Whereas when you do it by a beneficiary designation from the insurance contract, then the insurance company, upon receiving the proof of death, will pay directly to the charity, so they will get the full amount once that fairly simple administrative task is completed by giving the appropriate proof of death. Other possibilities with insurance is, if you have an existing insurance policy which you no longer have a personal need for, then you might be inclined to just allow it to lapse, to cancel it out. But it's also something that you could transfer over to the charity. So assign the charity the insurance policy, and when you assign the insurance policy to the charity, there is a value that would associate with that, and you could get a tax credit back for having assigned the policy to the charity. And then related to that, either you transferring a policy to a charity or taking out a policy and allowing the charity to be the owner of it, you could pay the premiums on the policy that then belonged to the charity, or continued to belong to the charity once you had transferred it to them. And the premiums that you pay on that policy would then be entitled to receive a receipt from the charity and give you a donation tax credit associated with the premium payment. So there's a whole variety of ways that you can do donations using insurance. And then the last thing I'll bring up is definitely a more advanced application for planning how it is that you are going to provide for a charity where you have some type of property, substantial capital property, that you would like to donate to the charity, but you still want to make use of it yourself. And I'll use the example as an actual case, which I worked on. I had a couple of cases like this, where it was a professor at a university who owned a house right on the perimeter of the university and wanted to donate the house to the charity. She was retired and wanted them to be able to have this as one of their university properties. And she was living in the house at the time. And what she was able to do was to create what's called a charitable remainder trust, where she set out the trust and continued to own the property and live in the property for her own benefit for the remainder of her life. But then upon her death, the capital of the property would then flow over to the university as the charity. So she received a tax credit, having obtained a valuation using an actuary of what the capital value is of the remainder going over to the charity based on her age at that time. So effectively, the tax credit that otherwise would have arisen upon her death by going through her estate, by having the house go through her estate. She had no family, by the way, no other family other than herself. So the tax credit that otherwise would have applied upon her death, instead, by making the donation through the charitable remainder trust, she got the benefit of the donation and was able to use the tax credit to offset a significant amount of her taxes for quite a number of years. So it was a really great way for someone who really wanted to give back to her own community, physically her own community and cultural community, in a way that they got the land, they got the property into their hands, and she got the tax credits associated with it, which allowed her to live out her remaining life comfortable that she's going to have reduced taxes for quite a period of time, and that the university is going to receive the house and be able to use it as part of their campus thereafter. So Paul, that's everything that I've got here. I'm going to, I'll leave this up here and I'll let you come back and pick it up from there and let me know if we got any questions that came up there.
You know, absolutely, Doug. This is great. Thank you. There was one question, and thank you, Karen. Behind the scenes here, added the link about the sessions being recorded for later watching. Yes, all of our events are available on the Libro.ca website on our events page. You mentioned earlier in the presentation, Doug, you know, the ability to donate, perhaps we'll term it more unusual items. Like artwork and things like that, maybe old cars, whatever it might happen to be, that doesn't have an easily determinable value. How do you go about determining the price of those donations?
Though, well, that presents challenge is coming up with a value which is something acceptable to the Canada Revenue Agency. And so if it is something which is unusual, then it won't be sufficient to come to an agreement merely between the two of you, the charity and yourself, what you think the value is for this old Dodge truck, if that's something that you donate. You would have
I was thinking more of the classic car, perhaps. The versus
Isn't a Dodge truck?
Nothing wrong with Dodge trucks, but depending on the age and stage of it.
Yeah. But you definitely would have to have something as an independent arm's length, so it couldn't be your cousin. It would have to be some kind of an arm's length valuation that Canada Revenue Agency would be comfortable that it does actually reflect in a reasonable way what the value is for that property. Sometimes some of the donations that come up ask about real estate, particularly, and I'm talking about large donations, obviously, right. But real estate. Could you just have your local realtor arm's length from you, but could you have them give you a value based on comparatives around the neighborhood? Maybe that might work. I would make sure that you're talking to a lawyer who's assisting you with this, a tax advisor who's dealt with the Canada Revenue Agency on those kinds of donations, and whether that would be sufficient, or if you really did need to have a proper full valuation done in order to reinforce the donation. Because again, you're talking about a very large donation. It's not the kind of thing that you want to do it on the cheap. You want to make sure that you get it right.
Yeah, and with our silent partners at CRA in our income journeys, I guess, and the more accurate you can be up front, the less issues you're going to have on the back end. Question, is there a limit to the dollar amount of securities that can be donated annually?
There's no limit to the amount that you can donate. The limit of what you can use is that 75% offset for your net income and the carry forward for the next 4 years on top of the current year. I know I always say it as 5 years, but you can make use of 5 years worth this year plus 4. So you can donate as much as you want, but if you make really, really large donations and multiply 75% times 5 years, you can't offset all of that net income, then you won't be able to use all the credits even though you made those really large donations. So no limit on what you can do, but there is a limit on how much you can use of it.
Right. So you touched on during your presentation a bit around the private foundation, and we do actually have some of our owners that have gotten involved in those conversations. Our Libro Wealth Management team, which works with some of our higher net worth owners, business owners, farm owners, etc., have had some reason in recent years to get into some of those conversations with owners. Is the use of the foundation perhaps a way you can be a little more in control of the timing of those donations for tax reasons?
Yeah, I think each of them, they will they'll share with you their operating procedures. You wouldn't be able to nitpick about it and make donations on a weekly basis in some way. There'd be some kind of reasonable limits to how you would do it, but generally you would be able to determine what charities would receive the funds from that foundation. And some of those foundations, and Paul, I don't know which ones you're working with specifically, but some of the foundations are community-based foundations that geographically will support any of the charities in the local area. Others have a particular type of approach. They might be, again, an ecological type foundation, and so the follow-on donations from the foundation might have to go to that type of a charity. But as long as you've done your research ahead of time, you know what the limits are, what the constraints are, then you'll be in good position to then exercise the rights that you have once you make that original donation and get your tax credit, and then continue to give them the instructions that you want on how that money is going to be invested first while within the foundation, and then eventually distributed out to the charities.
Yeah, and we've had some owners who've donated to groups like for example, here in London, the London Community Foundation, and many of our communities that Libro serves have similar opportunities. But we also do have some quite high net worth owners that have actually looked into exploring the personal foundation, where they have just maybe a little more control on those distributions.
Now, Paul, we had the title up front that this is a year-end tax tips / charitable giving. So I do want to touch on a couple points related to making donations generally. With private foundations, with the donor advised funds approaches, those organizations are ready and able, set up to do that, and they can operate fairly quickly. If you are making donations of securities in kind, then be very careful that the charity, on receiving that donation of that particular security, they've got to have a brokerage account to receive it, and they have to have the appropriate approvals from their board of directors. Usually it's right up at the highest levels of the board of directors to receive securities. So here we are in the second week, we're roughly, the 1.5 week of December. And if you haven't yet spoken with the charity who you want to donate to, and they don't have a brokerage account, you may not be able to do that before year end. So if that's something that you intend to do, then you'll get on your horse now and let them know, who you want to donate to, that you'd like to do this. And if not them, then who else you might be able to make that donation to. Because if you don't get the donation actually in their hands, that they can say legally they have it under their control before December the 31st, then they can't issue you a tax receipt for this year. It's not the end of things. You'd still get the tax receipt, but it's going to be after the new year, and it may not be in alignment with what you intended to do with claiming your taxes. You want to claim it against this year. So there's your year-end issue that could come up.
Yeah, good reminder of the timing. I had a bit of a shock moment today when I realized my youngest only has 8 more days of school before her Christmas break. That made me feel a little bit odd about the rush and the year end. There's a specific question about what if the mutual fund is with an IRA account, which for those who may not be familiar with would be an American retirement account. But I guess maybe the more general question is possibility of donating either U.S. charities, or if the funds are from the U.S., like in this case, a mutual fund within the IRA account. Any specific considerations there?
Yeah, so as I'm talking about making the donations in kind, I'm talking about non-registered accounts. So not IRA, definitely, but not even RRSPs or RIFs. It is a non-registered donation that you would be making, that you would get that in-kind donation associated with that. As far as charities to donate to where you get the tax credit, you can actually donate to a lot of American charities and get the tax credit. The Canada Revenue Agency does recognize foreign charities, not every single one that claims to be from a foreign jurisdiction, but it does recognize a number of foreign charities, and particularly American charities. I don't know what the website address is to verify that, but I would start with the Canada Revenue Agency and punch in the foreign charities charitable tax credit, and I'm sure within 3 hits you'll come across the listing and the rules associated with that. So it's worth considering if those charities are the ones you care about. They just don't happen to be locally present, then you can look into that possibility as well.
Yeah, excellent point about, first choice is not using your RSP registered accounts to make these donations, because you'll kind of defeat the purpose of what we're trying to accomplish here, perhaps. I didn't publish the question. There was one in there recently. I guess over the past few years, and I haven't seen it quite as prevalent recently, but over the past few years, there have been a number of I don't know what the right word is, where CRA had pushed back on charitable donations that were overstated relative to the amount that the person had actually donated.
Yeah.
Other than if it sounds too good to be true, it might be. Any advice on those kinds of last minute, perhaps, attempts to cite donations and using enhanced receipts as the reason to do so?
Yeah, apart from it sounds too good to be true, if you are getting a tax credit which exceeds the amount which you are contributing, you would think, well, sometimes you do have things that give you very substantial benefits. But if you're getting a tax credit in excess of how much you are contributing, then that's a problem. And with a lot of those donation schemes, people were getting the credits not just exceeding what they are contributing, but exceeding it by multiples of what they were giving. I sat in oh man, this would be 25 years ago, pretty much, in the mid 90s or so. I sat in this this hotel room on one of these things out of interest in what they're doing. And each corner of the room, they had a starving artist that you would buy their painting off of for a pittance. You would then go over to the next corner of the room, and there was somebody who had this, I'm the valuator guy, who would say, oh, that's worth X amount. And then you go over another corner of the room, and there was the charity that you would give it to, and they would give you a charitable donation receipt, which way exceeded what you paid for it 10 minutes ago when you were at the other corner of the room. Like, you've got to sit back and say, let's be realistic here. It just doesn't work that way. So just be careful.
Fair enough. That's it for the current questions we had from the chat. And this might be a bit off topic. I'll throw a curveball at you here a bit. Perhaps we did a recent webinar on being an executor. We have done recent webinars on estate planning and other things. Is there any special considerations to making charitable donations if you're filing a final tax return for a recently deceased individual where perhaps you've been the executor or it's a family member, etc.?
Well, I would say that my I don't know if this is a direct answer to what you're asking, but my general guidance to people, and this is from having the experience a couple of times, as between naming a charity, as I mentioned, you can give them a bequest, you can give the charity a legacy, or you can name the charity as a residual beneficiary. Among those possibilities, and it's your call how you want to take care of them, but among those possibilities, I lean towards doing the legacy rather than making the charity the residual beneficiary or a residual beneficiary. And the reason I say that is because, again, ran into it in a couple of occasions where there was a charity, very large charity, which is one of the residual beneficiaries of the estate, along with family members. And so all of the activities of the executor were being overseen with just like a microscope, everything that was being done by the charity, who really were only entitled to a small amount of the residue. And it would have been better, because it was a small amount, if the charity had just been a legacy for the dollar amount. They would have gotten what they were entitled to, but then the executor would have had a lot less grief in managing the estate than being constantly overseen by that charity. And the charity, in fairness, because it was a large charity and they had their processes, they had to watch over everything that was happening, and that put the executor in a really difficult position. So if you want to take care of a charity and you already know roughly what you want to give to them, my opinion is start on the basis that you're going to do a legacy rather than making them residual beneficiary. And from a tax perspective, because the charity is a non-taxable entity as a residual beneficiary, the tax credit that you get from making a legacy contribution or legacy distribution goes back to natural people. Whereas if you make them a residual beneficiary, you don't get as much of the tax benefit of that because the charity is a non-taxable entity, and so it's kind of lost on that end of things. So there's my comment.
Excellent. I appreciate that. Well, maybe I didn't phrase it particularly well, but I appreciate the handling of that curveball. You put it over the fence, Doug. So I appreciate it. With that, given that we have no more questions in the time tonight, we'll probably call an end to the proceedings. I wanted to thank everyone this evening for their attendance. Thank Doug for his help and my Libro colleagues for their behind the scenes assistance. A reminder that Doug will also be offering, and we'll have this on our website, the 21 timely tactics to trim your taxes at December 14th, 12 Eastern, or December 15th, 3 Eastern. Those links and some other follow-up materials will follow, as long as some survey questions in an email to come. Doug, you had one more slide that you need to get to, or is it all? Did we cover everything?
That's it. We covered it. We're good.
Perfect. Thank you, and everyone, and enjoy the rest of your evening.
Thanks.